Well, we just came off hot CPI and hot producer prices this week, yet the markets brushed it all off. So I want to bring in Mr. Jim Welsh from Macro Tides to figure out why in the hell does the market seem not to care about any of this? So, good morning, Jim. How are you? Happy Friday.
I am good. Not only happy Friday, but happy Valentine's Day.
Happy Valentine's Day. Yes.
You know,
I didn't have it on my bingo card to say that to you this morning, but hey, here we are.
hey, I hope everyone has a Valentine and can enjoy this day. So anyway, I'm lucky. I do have a Valentine. So
Thank
okay,
goodness for all of us at home too. So,
amen. Happy wife, happy life. And if you don't understand that, you probably aren't, you don't have a Valentine if you're old enough. Anyway, moving right along. No, I think what's happening, Blake, is every issue that has come up in the last week or so is immediately dismissed, for one reason or another. So you get a hot CPI and the PPI, and Powell doesn't react to it, which is understandable. I mean, he has said repeatedly, we don't react to 1 month. They're going to look over 2, 3 months and see what's going on before they're going to say, all right, that's actually a trend as opposed to a blip, especially given that January last year and the last couple of years, you've seen this pop in inflation. And so it could be just the seasonal adjustments aren't handling it correctly and so forth. In terms of the tariffs, yesterday President Trump signs a thing regarding, reciprocal tariffs. All right, but it's not for 30 days, which means it's not going to happen. And what we saw on February 3rd, the initial bout of tariffs, pardon me. Oh, well, Mexico and Canada say, well, we'll do some stuff on the border, and so you get a 30-day reprieve. And markets are reacting as if, all right, it's going to be 2018 all over again. Trump is going to do some barking. At the end of the day, the tariff threat is nothing more than a negotiating uh, tool. He'll get some concessions, and then it's going to be over. And I really, 3 weeks ago, that was my view. And after listening to comments that Besson has made and thinking about it, I think there's a real risk that this tariff stuff is going to get far more serious than most people realize.
well, and you brought some charts to support this, Jim. So let's go ahead and just jump into some of
Yeah,
your charts that you brought,
yeah,
and let's start off with
go
this
from
one
there.
here. So
Yeah,
we're chewing our leg to make some fat. Is that what you said here?
something getting fat by eating our leg. So I think that Besson and Trump and other people that are now part of the administration look at what's happening as being we're at a make or break time period where we need to address the amount of government spending, the size of the deficit, the amount of interest that the government is paying on all that debt. And this conceptually, you can see after the financial crisis in 2008, spending and therefore debt, because a lot of it is obviously a deficit, is growing faster than GDP. This is unsustainable because at some point in time, the music stops and there's no chair to sit in. And so to me, this is one of the things what Trump and Bessent are really focused on is we need to do something, and the sooner we do it, the better. The longer we wait, the bigger this problem becomes, the more challenging it becomes. So again, just basic economics. You cannot survive for the long term if debt is growing faster than the size of the economy.
But can you survive another 4 years? And so here, Jim, you and I, we've been in the markets long enough. I've literally been watching Donald Trump on CNBC and Bloomberg since 1996-ish,
Yeah,
and I've seen him do all sorts of things. And if there's one thing, and I'm going to play devil's advocate here, if there's one thing
yeah.
that I've understood about Donald Trump is he really just cares about himself. Now, because of where we're at in our economy and debt to GDP and blah, 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 you think he brings in the right people to say the right things because this is the right thing to do. But again, playing devil's advocate, knowing what we know of Donald Trump,
Sure.
do you think he really gives a shit about this, Jim? I mean,
At this point in time, I mean, I'm not going to say that your conclusion is wrong. At the same time, I think Trump was changed, whether it's a 2% change or something more significant, by two assassination attempts. And again, so I think he's more serious. Now, time
and
will
I'd like,
tell.
and by the way, I'd like to believe that too. I'm just again playing devil's advocate here, and I think
Yeah,
the way the
yeah,
market's viewing this is, Jim, I hear what you're saying. I see the numbers. It all makes sense, but Trump is going to be Trump, and he's out
right,
for himself. So
right.
if he can
Well, that
extend
I
the
think is
if he
why
can
the
extend the
markets are.
party and kick the can another 4 years, and he gets to
Yep.
party for another 4 years, so be it. Again, this is
Well,
I hope to God I'm
yeah,
incorrect
yeah,
here,
yeah, yeah, yeah.
but I'm playing
But
devil's advocate.
well,
Yeah.
and again, I think most people in the marketplace have the same view. And
Hmm.
that's why markets are reacting the way they have, that this is more bluster than reality. And
Okay.
he's going to do what people have expected him to do based on past behavior. So I get it. And maybe he is going to cave and it'll be the same thing all over again. I just think that there's a greater likelihood than what the market is assigning that they are very serious regarding resetting the global order. And whether or not they're going to be successful, I think it's a low probability bet, but I think that's their intention.
Well,
And let's go to the next chart
okay.
because,
Well, in the meantime, Jim, I already got my printed S&P 8,000 2026 hats made, so don't rain on my parade right now. So,
okay. So here's a chart. Again, these are the things that I think Besant understands and why he is the Secretary of the Treasury is that back in the 1960s, every new dollar of debt generated about 90 cents of GDP. So you were getting some bang for your buck. Over time, we're spending more deficit spending and we're getting less and less GDP. I mean, last year, woohoo, the economy grew 2.5%. The deficit was 6.4%. So, as that prior chart shows, as you get more and more debt, rather than spurring more growth, you actually get less growth because of the weight that debt has on an economy. And so, what this is showing is we're spending more money in debt, we're getting less and less GDP. That's untenable. At some point in time, you just can't be doing the same thing over and over again and expecting a different outcome. And so these are the things that I think Besson understands and knows. And the idea is if we continue down this path, we're going to have some really serious problems. And they may or may not be able to stem it. The next chart covers another aspect of this equation. And this is, what the Fed did. So real funds rate. So you can go back to the late 70s, you can see the real funds rate was extremely high when Volcker, said, I'm going to fight inflation. And until we got to about 2001, when Greenspan lowered the funds rate to about 1%, with inflation being about 2% or higher. So you have the last 25 years, most of which the real funds rate was negative. So that encourages the government to borrow more money, which it has. But as you can see off on the right, the Fed increased the funds rate above the inflation rate, especially in the last year or so as inflation has come down. So we actually have a real funds rate. And this is a positive development. But the next chart shows the cost of doing the right thing. And this is interest expense. So this last 12 months, interest expense 1.1 trillion. The government took in a little over 5 trillion. So in other words, 20% of the money the government collects isn't going to help anybody or provide more defense for the country. It's just to pay interest. And you can see how that red line, which represents the interest income, it keeps moving up. And what happened this week, there was a 10-year Treasury note from February of 2015 that came due. It had a coupon in 2015 of 2%. Well, they rolled the money over to 4.5%. It will add 1.6 trillion, probably billion to the annual deficit. But you're doing this on trillions of dollars of debt. And so as we have higher for longer, more and more debt is getting repriced. The average maturity on the debt, I think, is around 5 years. So that means a lot of the debt that was issued back in 2020, 2021, when rates were very, very low, is going to increasingly come due. And so interest expense is going to continue to work its way higher. This is untenable. So when you look at all this stuff, you say, wait a second, either we change course or we have a very serious problem. And so Trump made a comment in a meeting with Republicans in January. He said, I think we could raise $1 trillion from tariffs. So if you think about this, Besson has said we need to extend the 2017 Tax Cut and Jobs Act. That will add about 4 to 4.5 trillion of debt, or create a deficit of that amount over the next 10 years. Well, you can't get the 10-year yield down if you're going to be increasing the deficit and future debt by that amount. The only way you can negotiate and get the bond market to believe that, wait a second, these guys are actually going to take credible actions. And so cutting spending, getting rid of, wasteful, stupid spending, it's not going to be a huge number, but it's a real number. So they have to come up with a credible plan to show that, yes, we're going to pay for that tax cut extension, and we're going to do it with tariffs. And I don't think people will fully appreciate that from their mind. It's like, we got to get the 10-year yield down. And the only way we can get the 10-year yield down is to present a credible plan that we're going to cut spending, so that we can get the tax cut, because otherwise that 4.5 trillion deficit turns into higher taxes. Is that going to help economic growth? And then on top of it, Besson has said we need to get the deficit from 6.4% to 3%. Getting rid of $1 trillion of spending is not going to give the economy a boost. So in the short run, you've got a lot of factors coming into play here that are likely to weigh on economic growth, but in the long term is what we need to do. So again, for this game plan to work, they need to keep and get the 10-year yield down. The only way that happens is if they can show, you know what, we're going to cut deficit spending by half, and we're going to do it in a way that you actually believe we're going to do it. So if what and I think most market participants, I don't think fully grasp what's going on here. It's like a reordering of the global economy.
Sure.
And it's a long shot that they're going to be able to do all. I mean, this is like threading a needle. We're going to have tariffs. It's going to boost inflation, but we're going to do other things like cutting regulation that hopefully reduce costs. I mean, it's a huge endeavor.
So,
But
Jim, this is where your macro analysis meets the technicals. And so I hear everything that you're saying. But what you are saying is that if the Trump administration really means business, the dollar should reciprocate in a bullish fashion. In your next chart, you have long since said that the dollar index is going into the 90s. So
right,
how do you expect that to happen in your previous scenario?
yeah. Well, I think it's pretty straightforward. As I said, the bottom line is all these changes in the near term are likely to weigh on economic growth. The economy is going to slow. Last week, Trump said, yeah, the Fed did the right thing by not doing anything with rates. And then this week he tweeted out something like, well, they should be cutting rates. I think part of it is, Blake, that he understands that when they raise tariffs, this much money, that's going to take money out of people's pockets. It is going to be inflationary in the short term, and it's going to weaken the economy as a result. So I think what's starting to happen is people are looking and saying, if the US economy slows meaningfully, that's not positive for the dollar, irrespective of tariffs. And I think that's what's starting to happen is
Okay.
that realization in the currency markets that that's what's coming. And obviously, if the economy slows more than what anybody expects at this point in time, the CPI number came out, and immediately Wall Street's like, oh, maybe we're only going to get one cut this year. Again, I think potentially you could see multiple cuts if the Fed sees that the economy is meaningfully slowing, and that will offset a rise in the unemployment rate will offset what they perceive to be a one-time boost to inflation. In 2018, they did models and they said, you know what? It's a boost. It's going to be a bigger boost potentially this time around. But if the economy weakens, I think they'll emphasize uh, any increase in the unemployment rate as directing policy. So again, the chart pattern suggests that, for 2 months or so, we've been talking, the dollar's making a high. There was, to your point, then I was like, well, there's still a chance if they really do this tariff stuff that the consensus about the dollar rallying, but it's not working out that way, you know? So anyway, to me, the chart suggests that a top has formed. It's a meaningful top. I think it's supportive of the idea that over the next 12 months or so, the dollar is going to trend lower.
Okay. All right. Right. I hear what you're saying. All right. So the next chart is going to be TLT, and the TLT has been a bit of a whiplash this week. I know we were talking about it this last week, and I was telling you my idea of the inverted head and shoulder pattern. Looked like it was round, and
Yeah.
then we got a reversal. Then that looked like it did. Then we're getting a complete reverse of that. So I mean, it seems very, very neck brace ish
Yeah.
price
Yeah.
action. So what do you make of
Yeah.
it?
Well, again, I agree with your assessment because, when the CPI report came out and, TLT got whacked and treasury yields popped and all that. And then Powell said, well, we're not going to react to one number. That helped. The retail sales number today came out, was far weaker than expected. That helped the treasury yields further. I think what I'm looking at, Blake, is it's still below that trend line it broke down from. All right, that's important. The
Yeah.
downtrend line, as it was working its way lower, it's still below that. Those are two key things. And as I've talked about the last couple of weeks, is that the last three trading lows in TLT occurred after it sold off, got oversold. The bottom panel is the RSI getting down to 30 or below, bouncing and then going to a lower low that set up a positive divergence. Now, there's no rules that say, well, it has to do that. If economic data comes in that's weak enough, uh, we won't get that retest. But given the technical things staying below the trend line it broke, the downtrend line, to me, I'm going to leave open still the possibility that we're going to see another shot down. And again, in the short run, if they get serious about the tariffs, there is going to be, as I've noted probably over the last 2 weeks, in 2018, it represented about 30.3% of GDP. What he's talked about is 1.1%. So we're talking about a more significant inflation pop. Again, it's one time. The tariffs pass through the economy. You're not going to get another one a year from now in all likelihood. So, but I think that could set up a jolt for Treasury yields if it's a holy Moses. They really are going to do this, and companies are going to pass along those tariffs, and we're going to see inflation tick higher. Oh my God, maybe the Fed will actually raise rates this year instead of cutting. I think that's a risk. And if we get to that point where people start talking about, whoa, now, the chance of the Fed raising rates 2 weeks ago was near 0%. It's up about 23% now. Again, still not likely, but my point is if we get to that place where people start really talking about it, I think markets obviously react to that kind of talk. They're not going to want to own bonds, and I don't think they're going to want to own stocks.
Okay. All right. Well, I guess time will tell
But yeah,
there.
in the fullness of time, we'll just see
Right.
how wrong Welsh is.
Well, no, it just is. I mean, we gotta go wait for the incoming information. I
Yeah,
mean, so
yeah. What
the
the
next chart is gold. I know we've all been kind of floored how strong it's
yeah.
been, and again, I can't find an argument to argue to argue the downside in gold, but we are having we've kind of struggled as we've hit this 2950 level. What are your thoughts here?
Well, last week I went through, showing that there's a squeeze going on in gold. Money
Yeah.
coming out of London going to COMEX. The borrowing rates have gone from 0 to over 6%. And those are all the earmarks of some kind of a squeeze. I don't understand what's driving it, but the net result is that it's causing kind of an unrelenting march higher. And when you're in the middle of a squeeze, you can throw to me, you can kind of throw technical analysis out the window.
Oh, absolutely. Yeah. There's
I
speed
mean,
bumps.
it's just like, okay. Um, but once the dynamics underpinning that squeeze run out, then you usually get a very sharp break. But until I have no idea how long the squeeze is going to last and what price gold can get to. Trying to just interpret the chart as it's in front of me, I thought we were going to have a drop down to 25.41 or lower before we got a big surge. Well, longer term, yeah, I kept saying we're going over 3,000 after we get a correction. So now looking at the chart, it looks like the low at 25.41 was wave four, unbelievably short in terms of time. One, two, and we're, somewhere in wave three, probably nearing the end of wave three. So there's a pullback coming and then another push higher. And, again, that's just trying to deal with what's in front of me right now.
All right. Well, then the last chart, we want to know how's that going to affect stocks, and you obviously are looking at the S&P with a possible break higher, I guess.
Yeah. I mean, let me go back first. If you look back to about 2 months ago in December, the S&P at 6,100. Look at what we've done for 2 months. There's a lot of back and forth and so forth. Net, the S&P's virtually made very little progress. Broader averages like the Russell 2000, the Eco Weight are down relative, I think 4 or 5% and so forth. Just looking at this chart, I thought last week that we were going to have another leg down that would get below 59.24 and then potentially have a move that would take the S&P really, more meaningfully above the 61.28. So instead, again, it looks like you had this spike. Look at the blue down channel. So that drop down, tagged it. Got a big move up. I thought we are going to have another pullback before we would go. Instead, we've got that sharp drop. We had a snap back to 61.01, another ABC to the low a few days ago on the CPI number, and we've taken out those tops. So as long as the S&P holds above that red, the top upper red declining line, I think the potential pattern is we're going into wave three of wave five, which gets you 6,300, possibly higher, you know. But if the S&P reverses and gets back below that red trend line, I think that's like, okay, um, that just it's time to reassess, you know. So, and
Well,
again, I think what's happened with the market, same thing. A few weeks ago we had the deep seek thing, and oh my God, Nvidia got crushed and all that. And then all of a sudden we're seeing how much money Microsoft and Google are spending on stuff. And here's YouTube, who isn't spending money on hardware. They're spending it on the software side. And the stock went up, I think, 18 or 19 days in a row. But what's happened for NVIDIA, Blake, is, well, wait, these guys are still spending a ton of money. And NVIDIA's had a pretty meaningful rally from, I think, 113 and change. Last I saw was, I don't know, 134, 135, something like that. I'm not sure where it is this morning. I didn't look. So I think that's the other thing that's going on, is just the idea that this amount of money that's being spent is still going to be supportive of NVIDIA.
All right.
And
Well,
so again, it's another thing like deep six. Oh my God. Oh, we don't have to really worry about that. So
it's
everything that's come along,
deep seek, deep seek.
deep sea.
I know you
Yeah.
want to say deep six all the time.
Yeah. Well, I did. I had my letter was deep seek, deep six is NVIDIA. I thought I was being really pretty
You live
cool.
in Southern California near submarines. I get it. It's part of
Yeah, North
it's where
Island,
you
there you
live.
go. So
Um,
anyway, the main thing I would say is just the expectation, understandably, that Trump is going to bark and bluster, and then it's going to be business as usual. He'll get a few deals. We're off to. If that proves wrong, I think markets aren't priced for the other outcome.
Right. All right, Jim. Well, I appreciate you breaking it down every week, and I know everybody else does. And if you guys have thoughts on what Jim had to say today, jump down in the comments below. And Jim, what's the best way for traders to follow your work and to get your most recent technical review?
You want the most recent? Jim Welsh Macro at Gmail. Otherwise, go to macrotides.com.
And tell him you're from you've heard him on Traders Summit. This way,
Yeah,
he'll give you a discount too. So.
absolutely.
Jim, I hope you have a great week. I'll look forward to catching up with you next week. Thank you so much for spending your time with us. As always, we all do appreciate you. Give him a thumbs up and actually
Thanks.
subscribe to the channel, because it's free to do both those things. And when you subscribe to the channel, you don't miss any of this exclusive content only found here on Trader Summit. Thank you, Jim.
Hey, thank you, Blake. Have a good week.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.